As you may have noticed on the slides, there are a bunch of different names of different firms. BPM is part of a larger organization where we have basically in every country in Europe and throughout the world actually member firms. And those firms are providing the opportunity for BPM to manage large-scale projects. Today we'll focus on VAT, but obviously that is not only limited to VAT. We can do corporate tax restructurings basically all across the world because of this fantastic organization. And the guys today on the VAT are all experts in VAT or customs, and we have monthly talks. We are as good as any other firm in this area. If logistical changes are going to be required, obviously you need to start looking at where are my clients. And if for instance, we have a lot of clients who use the UK as their main entry into Europe. And from there, they service the EU market. Again, that's going to be a more difficult proposition because the EU now is not including England or the UK. So what you don't want to end up is a situation where you import goods into the UK and then as a subsequent step have a separate EU customs duty hurdle. So again, this slide, which is potentially somewhat biased in terms of where the markets are. But I just wanted to show this as a kind of an exercise in how you need to approach those questions. But in the current EU-UK relationship, which will change as of January 1, 80% of the UK exports go through French ports or ferries, or as you can see on that map here to the right, the tunnel, which for people who took that tunnel, it's a great engineering feat, and it's a great way of moving and people, trains, goods through. But that's actually, we'll get to that later, but that's actually going to be one of the contentious points, so to speak, how that will go as of January 1, because there's going to be some imaginary border somewhere in the middle of that tunnel, which is not very it's a very narrow tunnel. It's not going to be a tunnel with all kinds of customs facilities in the middle, but we'll go through that, what in practice this will mean for clients who are, for any UK company or person who is moving goods around between the UK and the EU. Okay, with that introduction, I think we need to go to our next slide with Lucy, and she will specifically deal with the customs duties between the EU and the UK going forward as of January 1.
Thank you, Frank. My name is Lucy Sutcliffe. I'm the National Customs Director for ASETS. And what I want to do through this session is just going to take you through some of the customs considerations that you might need to look at if your goods move between the EU and UK, and that would include the island of Ireland. So I wanted to start by briefly summarising the current situation with regards to the relationship between the EU and UK. If we can move on to the customs recap. So as Frank mentioned, on the 31st of January, that should actually be this year, the UK withdrew from the European Union. And at the end of this year, the end of the Brexit transition period signals an end to the UK's membership of the EU Customs Union. And therefore it will result in changes to the movement of goods, capital, services and labour. But it also represents a shift in the future trading relationship between the UK and the EU and introduces new obligations and compliance requirements for businesses which deal with the UK. As Frank mentioned, in the absence of a trade deal between the UK and the UK effectively leaves the current trading relationship under the transition phase with a no-deal Brexit scenario. So this will result in the introduction of customs formalities and associated compliance obligations for goods imported to and exported to and from the UK and the EU. Let's look firstly at the movement of goods from the EU to the UK. If we can move on to the next slide, thank you. So currently when goods move between EU member states, they do so under a harmonised system across the European Customs Union. But as I've said, from the 1st of January next year, goods moving from the EU to the UK, these will attract import duties, and customs formalities will also be required in the absence of a trading agreement. This will result in a change in the customs obligations and the associated documentary burdens placed upon UK businesses and potentially businesses which trade in the UK. So for importations into the UK, the declarant for that movement will need to submit a customs declaration to HMRC, which is the Customs Competent Fiscal Authority in the UK. And in order to do this, you'll need to establish some information. The first being the commodity code used to identify and classify the goods. And this can have a huge impact on the level of import duties to be levied. Each code is made up of several different elements, which describes details such as the broad type of the product, the material used to make it, the intended use, and even the type of method used for production. Currently, the commodity codes used at importation into the UK, this consists of a 10-digit number, which corresponds to the import duty rates to be levied. From next year, you will need to provide a commodity code for the goods for the import declaration, and these codes will need to accurately reflect the products. So if you haven't done so already, now would be a good time to consider and confirm the commodity codes, which you may have to use at the beginning of next year. But a word of caution, if you use an incorrect commodity code, you may end up paying either not enough import duty or paying too much, which would obviously affect your business costs and profit margins. You also may inadvertently be importing goods which are subject to a quota or a preference. The UK has published the UK Global Tariff, which they intend to introduce from January next year. And this will be an important change to the level of tariffs and quotas which will be applied to goods imported into the UK. And this will replace the UK's reliance on the EU Common External Tariff. Now, this new tariff, the global tariff, will apply to goods imported into the UK unless certain exceptions apply, such as a relief or a tariff suspension. Or perhaps the goods come from countries that are part of the generalised scheme of preference, or indeed the goods are imported from countries which have a trade agreement with the UK. Now, the good news surrounding the UK global tariff is that this tariff or these tariffs will apply to imports into the UK from both the EU and rest of world countries, so countries outside the EU, therefore your global markets. If you've already looked at your future import duty exposure based on the EU tariff, it would be useful to revisit this to see whether the UK global tariff enables you to reduce some of your anticipated costs further. There are other factors which you'll also need to consider, which relate to the movement of goods from the EU to the UK. And the customs valuation is a fundamental part of this process. This determines the level of import duties applied to a consignment of goods. Now, the customs valuation is not purely the cost of the goods, so the price that you might have paid for them. It also includes insurance and freight charges connected to the movement of the goods to the EU border, as well as other costs. So for example, selling commission, tooling charges connected to producing the goods, and even the proceeds of resale if you share the profit of resale with the seller, whether that's directly or indirectly. They potentially need to be included. Other costs which can be excluded are costs such as buying commission, quantity or trade discounts, and even if you're related to the seller, the discounts can also be or may be allowed, providing that the relationship has not affected the price of the goods. So one sort of final point on this before I move on to the different methods is that everything has a value for customs purposes, even if no import duties are levied. There are 6 main methods of valuation, and method 1 is referred to as the transactional value, and generally it's the price paid or payable by the buyer to the seller. It's also the most common method used, and it applies currently to over 90% of importations. And for information as well, it is probably the easiest method to demonstrate. And that's usually evidenced with a customs commercial invoice between the two parties, the buyer and the seller. One area businesses should consider now is goods moving between connected or related entities and what will happen at the end of the transition period. So if you have a subsidiary or a parent in the EU or UK, currently you might be transferring or moving goods between the two companies free of charge effectively and with relative ease. But at the end of the transition period, these movements will fall under the new customs requirements. And if you can't evidence a sale between the two parties, you may have to use one of the other methods, which can increase your import costs and also tend to be more complex to evidence. The origin of the goods may also be important if you or your customer are seeking to rely on this to claim a tariff preference, or when we consider any quotas or embargoes on the importation of certain goods. Supporting documentation you will also need to consider. So you may need to render, but also importantly retain certain documents, including safety and security notifications, health certificates, IPATs, and this is for animal products and live animals, pre-notifications for certain goods, weigh bills, customs commercial invoices, which I've already mentioned, and packing lists. And this is to just name a few of the documentation. One area which is also often overlooked by businesses and which will be of increasing importance as we move to the end of the transition period is Inco terms or shipping terms. And you'll need to establish which entity along the supply chain will be the declarant for these movements and confirm the Inco terms between the relevant parties. Inco terms define where both where the responsibility and liability rests between the seller and the buyer of the goods. So they confirm each party's responsibility in respect of customs obligations, freight costs, insurance costs, risk, delivery costs, and of course customs formalities in the country of dispatch and the country of destination. If we move on to the next slide, this gives you a more graphical example of some of the Inco terms that you can actually consider. So imagine you're a UK business buying metal tubing from an EU supplier, and you currently buy those goods on the equivalent of delivered duty paid basis. So that's to the right of this slide. At the end of the transition period, your EU supplier will be responsible for all of the associated costs, including the customs formalities in both the EU and UK, the movement of the goods from their door to your door in the UK. But by comparison, if we look to the left of the slide, if the same UK business buys the metal tubing from their EU supplier on an ex works basis, this reverses the responsibility and liability. So the UK business would be responsible for the cost of moving the goods from the EU to the UK and the customs formalities in each jurisdiction. So that's EU and UK. Now this may then lead on to a requirement for the UK business to be established in the country of dispatch to render an export declaration under the Union Customs Code legislation. The use of an alternative Inco term, such as FCA, which you can see just next to Ex Works on this slide, would mitigate this liability. Many businesses have existing contracts which are silent on the point regarding Inco terms. Now is the time really to revisit these and renegotiate, if at all possible, to avoid being forced to accept unfavourable terms, but also to minimise your future costs and any potential increases connected to the movement of goods within your supply chain. If we can move on to the next slide. For businesses importing into the UK as the declarant, you will need a UK EORI number which has a GB prefix. And for EU established businesses who wish to make customs declarations in the UK as the declarant, HMRC have advised that you can apply for an UK EORI number without the need to be established in the UK. With effect from the 15th of July last year, so that was 2019, HMRC clarified the position regarding the recovery of import VAT. And HMRC explained within their related guidance that they would only allow the owner of the goods at the time of importation to recover the import VAT. So therefore, the correct procedure really, in order to be eligible to reclaim the import VAT, would be for the new owner of the goods to be the declarant for the movement, at least the simplest form of being able to achieve this. I'm sure Greg will cover postponed VAT accounting in a little bit more detail in his section, but I just wanted to also draw your attention to the fact that the UK will introduce postponed VAT accounting for UK VAT registered businesses at the end of the transition period. So this means that if you are UK VAT registered, you can account for import VAT on your VAT return rather than paying this when the goods reach the UK frontier. But if you're not UK VAT registered or not eligible to use this easement, you may find that you have to pay the import VAT at the frontier. From January next year, the UK will leave the EU's Common Agricultural Policy regime. And this regime is intended to protect EU agricultural industries by placing additional levies or duties, so cap duties, on certain goods imported into the EU. These cap duties were also applied by the UK as an EU member state. But the UK's withdrawal from the EU and this regime means that if you import goods where cap duties are currently applied, going forward these will be removed, which will provide a tangible cost saving for your business. It may also open up potential avenues for you to explore in terms of new supply chains for these goods. The Goods Vehicle Movement Service is an IT platform which is currently being developed and which is intended to support the pre-lodgement model, which the UK government are looking at introducing for both imports and exports, and to facilitate transit movements. This system will allow declaration references to be linked together so that the person in control of the goods has to present only one single reference, so a goods movement reference, at the frontier. And this will enable them to prove that any pre-lodgement and declarations have already been rendered to HMRC. It's also expected that this system will enable a link to be put in place to link the movement of the goods to declarations, so that goods boarding on the EU side can be processed by HMRC en route via a smart freight system. This will result, unfortunately, in the introduction of new responsibilities for goods which are carried by road, and this may be of specific relevance to hauliers and carriers of goods. I wanted to move on to cover the island of Ireland on the next slide. So it's intended that the island of Ireland will operate under the principles of the dual tariff regime under the recently published Northern Ireland Protocol. And the protocol aims to avoid the introduction of a hard border on the island of Ireland. And what the regime will mean is that whilst Northern Ireland will remain part of the customs territory of the UK and will benefit from unrestricted access for Northern Ireland businesses to the rest of the UK internal market, it will also be subject to the European Union's customs rules and a wide range of EU single market rules with regards to goods. The protocol itself sets out the conditions under which goods can move tariff-free between Great Britain and Northern Ireland, and at the same time move without customs controls between Northern Ireland and the Republic of Ireland. So for goods moving between Great Britain and Northern Ireland, these won't be subject to a tariff unless the goods are at risk of being moved into the EU afterwards. And these movements will be recorded digitally using the new Trader Support Service system, which has very recently been launched. The government will allow companies using the Trader Support Service to render digital movement documents free of charge. For goods moving between third countries, so outside of the EU into Northern Ireland, for imports, they'll be subject to the UK tariff, UK global tariff, unless they're at risk of being moved to the EU. Goods being exported to rest of world or third countries from Northern Ireland will be subject to the normal customs export provisions. And for goods moving between Northern Ireland and the Republic of Ireland, the EU's Union Customs Code legislation will apply, which means there'll be no tariffs or restrictions provided that the goods remain on the island of Ireland. Additionally, Ireland will be classed as a single epidemiological area for health, hygiene and food movements. And as such, health, sanitary and photosanitary checks, so SPS, may be required on goods entering and leaving the province. Some of you may have heard of the Common Transit Convention. And the UK will remain a member, an independent member of the CTC. And by using the Common Transit, you can actually move goods quicker between or through common transit countries because customs declarations and duties are not required at each border crossing. It also allows you, this provision, to complete some customs processes away from the border. I want to move on now to look at the movement of goods from the UK to the EU. So again, from January next year, goods moving from the UK to the EU are likely to attract EU import duties in the absence of a trade deal. And this will result in a change to the customs obligations as well and the associated documentary burden placed upon businesses, and also the requirement to render an export declaration by the declarant in the UK. Again, commodity codes will be relevant, so you will need to consider commodity codes used for export, which is currently an 8-digit number. This allows the importer of the goods in the end destination to provide a commodity code in the country of destination, which is used to arrive at the rate of import duty, which will be levied on the goods. As I've mentioned, the tariff levied on goods exported from the UK and at importation into the EU will be based on the common external tariff. Again, the Inco terms applied for these movements will determine which party is responsible for the EU import duties. So really, really crucial to look at those. Supporting documentation, you'll need to ensure that any supporting documentation or certificates required by the EU country of destination are obtained and available upon importation, as required by the EU Fiscal Authority. Moving on to now the EU EORI number. So UK businesses importing goods to the EU will need an EU EORI number, even if they use a third party, so maybe a freight forwarder or customs agent, to submit their declaration. This will be the case if they were to act as the declarant for the movement. So if the EU customer is prepared to act as the declarant and they're established in the EU, then this requirement would potentially be mitigated. But please note that currently some EU member states may require businesses to actually be established or engage an indirect representative to act as a declarant. You may also need to consider EU regulatory alignment and common standards, which can also extend to labelling requirements for goods, for UK goods entered to the EU marketplace. So that's just something just to bear in mind. And finally, the for any UK manufactured goods containing milk, starch, sugar and protein derived products exported to the EU, these may still be liable for additional cap duties, common agricultural policy duties, over and above the prevailing customs duty rate.
Thank you, Lucy, and thanks for joining us today, everybody. My name's Greg Main, and I'm a VAT director with Assets based in the Southeast. If you get the chance to look back on the map that Lucy looked at of the UK, I'm based in Canterbury, which is in between London and Dover. And I'll come on to some of the interesting points about that particular geographical location in a minute. If you can move to the first slide, please. I'm going to start by looking at a bit of the background to the tax before I move on to some of the more specific issues and some of the scenarios that might arise when you're carrying out international transactions. VAT has got many different rates and exceptions and exemptions. It's a transactional tax. But broadly speaking, it applies to domestic transactions and imports of goods and of some services. Having a transactional tax system is a strict requirement for membership of the EU. So all 28 member states of the EU have a VAT system. But including those 28 countries, there are around 170 countries globally that apply a VAT or similar goods and services tax. And in general terms, VAT is a very efficient, cost-effective method of taxation. And to put that into some context, in the UK, in the financial year 2018-19, VAT contributed over £130 billion to the exchequer. And again, to put that in a little bit of context for you, that's about 17% of total revenue receipts. So it's a major contributor to the UK exchequer. It's also a very useful tool. A fiscal administration will use VAT as a kind of a spanner, if you like, from the toolbox, the fiscal toolbox, to influence consumer spending, to either increase or decrease spending, and also just to do some economic fine-tuning in particular sectors. As VAT is an EU requirement, the question that's often asked, particularly in relation to transition, is whether the UK will actually do away with VAT post-transition. Well, looking at the figures that I've just mentioned to you, the likely answer to that is no. It's too much of a contributor to the exchequer. But given the current economic climate and political climate, it's I say a foolish person who makes these kind of predictions, but I can't see it happening in the near future. I'm now going to move on to some of the key questions for VAT when you're looking at cross-border transactions. So having looked at the general background to the tax, these are some of the more specific points to focus on. And the first of these is whether the supply that you're talking about comprises goods only, services only, or a combination of both. You don't need to focus on where VAT might apply. And this is a geographical question because the place of supply rules will dictate where and when and how much VAT is liable on a particular transaction and who is responsible for it. This is important to establish as different rates can apply in different countries, as well as differing exceptions, exemptions and reliefs. So for example, in the UK, we have a general 0 rate of VAT on food products, whereas other member states in the EU have a higher positive rate. Now that can impact on import costs of bringing food products into the EU, bringing it into the UK, 0 rated VAT, bringing it into one of the other member states, a positive rate of VAT. And the next question will focus on who's responsible for accounting for that VAT. So Lucy's already referred to this in her piece when she mentioned Inco Terms. So it's not always the case that the supplier of the goods and services or services charges and accounts for the VAT on that supply. So it's important to establish who has that responsibility for the VAT. And we then need to look at the cost of that VAT, how much VAT will actually apply on the transaction, and whether that VAT is able to be recovered or whether there's any reduction, relief, or even suspension that's available. So next, we're going to look at the distinction between goods and services and how it can impact on VAT treatment. So we're going to assume for the purposes of this that we're talking about an export of goods from the US imported into the UK. So we've looked at the place of supply. It's slightly easier to deal with goods because they're tangible, they're quantifiable, easier to see and control. And that generally makes it easier to analyse from a VAT perspective in terms of value, movement and responsibility. So assuming these goods are moving from the US to the UK, we need to check the supply agreement to see who has a responsibility for importing those goods. And again, those Inco terms are important to check to see where that responsibility lies. We also need to know whether those same goods are for entry and use in the UK or whether they're going to be moved onwards to other countries. And I'll look at that in a second. And as with any movement of goods, anything to do with tax, of course, there has to be a clear trail of documentation to support the treatment for VAT and duty. So it's imperative that this documentation, and Lucy alluded to some of the documents that may be available for this, it's imperative that those documents are obtained and retained because inspection may be possible at a later date. The authorities may want to see what evidence there is to support a particular movement. So we'll now have a look at the process for moving goods onward from the UK. So if the goods are to be used or supplied in the UK, then there'd be a VAT charge at the point of importation. The standard rate of VAT in the UK is 20%, but there are lower rates that may apply to specific goods. Excuse me. For example, foodstuffs or printed matter. And the payment of this VAT may be postponed or deferred. Again, Lucy mentioned that earlier. And like many other states, the UK is implementing this particular postponed accounting measure from January 2021. If the goods are moving through the UK, then it may be possible to suspend the payments of VAT and duty by putting in measures, particular sort of transaction suspensions that could apply to these. But if they're being sold to the other EU countries from the UK, then currently we have a single market treatment. This would be an intra-EU supply, as Frank mentioned earlier. No VAT applies, no duty charges, excuse me. But post-transition, we're looking at an export from the UK and an import to the EU. And if there is no deal in place, the deadline for this keeps changing all the time. The current deadline that's being mooted is the 15th of October to put in place any deal between the UK and EU. If there's no deal in place, then additional charges would apply. So we can now move on to look at the potential measures and ways of avoiding those additional charges. So if the goods are stored physically in the UK, but fiscally, they may be suspended. So it could be possible to put them into a warehouse system, and they can be moved on without actually being cleared or entered in the UK. And that would mean that no VAT or duty would be payable. Again, whilst the goods are physically in the UK, they are not entered for any fiscal purposes. Putting that in place would incur additional system costs, another sort of layer to the movement of the goods, and also administrative costs. So it's not something to be done lightly, but it is a potential measure that could be put in place. Goods could be redirected to mainland Europe or Ireland rather than the UK, and that way they would enter into the single market, avoiding the potential for double duty charges, as Frank mentioned earlier. Again, moving goods is a costly measure to take anyway. So if you're redirecting goods into, let's say, Ireland, France, Netherlands, wherever it may be, that can incur additional freight costs, logistical costs, and administrative costs. So we looked at the supply of goods. If we can now move on, we can look at the supply of services. So for services, it can be a little more difficult to establish what is being supplied, who is supplying it, where it's being supplied, and who's receiving it. The complexity and ambiguity can make record keeping and accurate accounting more difficult. So assuming, again, we're looking at movement of goods from the US, or sorry, movement of services from the US to the UK, we need to establish whether the customer is a business or is a consumer, B2B or B2C, and what is the precise nature of the service. For example, if it was a US management consultancy service provided to a UK business, then that UK business would be required to account for a VAT charge on its UK VAT return. Alternatively, if it's a US digital product being provided and downloaded by a UK member of the public, then potentially that US provider would be required to register for and charge UK VAT. And that neatly moves on to the next part there, that BTE and MOS. So the BTE refers there to broadcasting, telecommunications, and e-services. And where a supplier of these kind of services, so for example, downloading music, films, software, online tuition, internet telephones, that kind of supply, where they're making those supplies B2C to customers in EU member states, then technically they may have an obligation to register in every single member state, 28 VAT registrations. The alternative to that is this MOS, mini one-stop shop, that allows just one registration to be made, and it's a kind of a clearing system for VAT. You register once and you account for VAT on all the supplies that you make to those other member states. And as a bit of a heads up there, this will be extended next year, from July next year, under a package called the e-commerce package. And instead of being a mini one-stop shop. It's just going to be called one-stop shop. And that treatment, that VAT treatment, will be extended to a wider range of goods and services, and it will have a particular impact on suppliers of low-value goods. So that's a bit of a heads up. July next year, this treatment, this registration in one place, will be available for a wider range of goods and services. So we're now just going to look at a quick summary of some of the key issues and points of interest for EU activities. Frank mentioned earlier the 80% movement of goods between continental Europe and the UK. We've got one border, physical border, which on Lucy's map between Northern Ireland and Southern Ireland. That's our EU border. But we also have just a 20-mile stretch of water between Dover in England and Calais in France. 35 minutes on a train, hour and 15 minutes on a ferry. And that accounts for, as we just said, 80% of the goods moving from Europe and beyond into the UK come through those French Channel ports. And that equates to 5 million truck movements per year. So it's a substantial amount of goods and products moving in through quite a narrow border there. The French authorities are actually introducing a new system. It's called Smart Border, and that will be deployed from January next year. It's an IT-based system to speed up the movement of products through the Channel ports and the Channel Tunnel. So it's going to hopefully help to ease any potential backlogs of vehicles. And I'll come on to a point on that in a second. The custom authorities are promoting themselves. They're also recruiting a lot of people to deal with this. The French, Dutch and Belgian authorities have recruited thousands of new staff and trained them to deal with cross-border movements of goods from next year. They're also promoting themselves as places to do business, bringing in postponed accounting, removing the need to have fiscal representation and so on. So there's a lot of sort of movement into position as the place to go to for businesses if they're not going to use the UK. On the final slide, if we can move on to that, there are some discussions, as Lucy mentioned, about this fiscal representation or place of establishment. If a business is looking to be an exporter, to sort of classify itself as an exporter in the Netherlands and Germany, then they may need, and it's been deferred until next year, but they may need to have an establishment in those countries or somebody representing them as a fiscal representative. So that's a measure that will be coming in from 1st of January. Italy is operating this beneficial VAT treatment for what's termed as a usual exporter, when you meet certain values. And also France has a favourable VAT treatment, which allows exporters to have zero rate applied to purchases if they meet certain criteria. So it's a very attractive proposition that's being put forward. For holding companies in the UK, they will no longer get this favourable tax treatment post-transition that they get as being a member of the EU. So if you have holding companies based in the UK, they may well find that leaving the EU will have a detrimental effect on their tax position. And non-EU suppliers who use sales platforms such as Amazon selling into the UK and EU will have to meet certain criteria. And under these due diligence measures, Amazon and the other platform providers have to carry out checks on the people using the platform. So there's another layer of administration that's going to be required for sales of goods into the EU. And just on the one additional point I was going to make there, living as I do down in the Kent region, which is not 20 miles from Dover, last month the Kent police carried out a quick border control check one afternoon on a number of vehicles, and their quick check resulted in a 22-mile tailback of vehicles heading for the Channel ports. And the county of Kent has been referred to as the biggest lorry park in the UK. So something exciting to look forward to. So the point to make here is that seeking good advice and in good time would be beneficial to most businesses. I'm now going to hand over to Andy Dorbarn, who will walk through a case study that will draw some of these points together.
Thanks, Greg. I'm one of the VAT specialist partners at Assets and based in London, although more accurately, I should say, based here at home not far from that lorry park that Greg mentioned earlier for the last 6 months or so. But as Greg said, we wanted to bring the issues that he and Lucy have been talking about for the last few minutes to life. So we're going to look at a scenario involving, in fact, an amalgamation of several clients of ours, all of whom operate in the entertainment sector, specifically the music industry. So we have our client who, in one of those names have been changed to protect the innocent type things, I think it was Dragnet. We're calling them the Rolling Clunge Music Group, which was formed several years ago to manage the interest of a rock group, which again, we are calling Proxy Music. Apologies there for the attempt at lightening the mood. I am, after all, a humble taxman, and I promise I didn't pick the topic just for the purpose of trying to crack a joke there. But I think the serious point is that whilst this might seem like a bit of a niche area, in actual fact, the issues arising are common to many businesses, including, for example, software houses and online retailers. And in fact, for any business which makes supplies of goods and or services in the UK and Europe, either physically or through an online offering. Through the case study, we'll take a look at the practical effects of Brexit and the transition period we're currently in, as well as the effects of the pandemic. In our client's case, the corporate structure is very straightforward, with essentially a single UK operating company and an offshore company in the Cayman Islands, through which several income streams are generated, from physical record sales on vinyl, which my kids assure me is quite big business these days, and downloads via various platforms such as Apple Music and so on. They receive royalty income, as well as income from touring, merchandising, and advertising and sponsorship. And the band were about to embark on a worldwide tour this year, but as a result of the pandemic, have had to postpone this. So like many others, particularly in this sector, they've had to rethink, and they've decided that instead of the live concerts, they're going to stream a number of these for viewing and downloading via a paywall. Band's management have decided they'll also make the tour merchandise for sale from 4 key locations around the world. And in terms of the royalty income I mentioned, the intellectual property rights relating to things like sales under license, copyrights, band image rights, and so on, are all held in the Caymans. So hopefully that sets the scene. Turning to the VAT issues arising, as Greg mentioned, we need to make a distinction always between goods and services for VAT. Mostly this is clear cut, although there are sometimes, it's sometimes more difficult than you might imagine with the classification of items like bespoke software, for example. But it's important because the regimes can be quite different for the two things. So looking at the band scenario, ordinarily on a physical tour, the tax issues are definitely complicated, and frankly they're perhaps a bit too niche for the purposes of this presentation. But from a VAT perspective, it's important to recognise that live performances are taxed in the UK and Europe where they physically take place. So this can be a real burden. Again, it's perhaps worth noting that these place of supply rules, as we refer to them, also apply to such things as trade fairs and exhibitions, as well as the things that Greg mentioned, like in-person training and seminars. For our clients, in practice, it's often usually the promoters as well as the venue operators, by way of ticket sales, sales of merchandise under license and so on, that would account for any VAT due on these activities. But in the current environment, the client sought advice from us on the fact that they would be taking direct responsibility themselves for sale and distribution of the merchandise. So next slide, please. If we look at point 1 on the on the slide. Next one again, actually, please. Looking at point 1 there, we've got the export of the goods from China into the various locations that are mentioned, and the issues all around the markets and their subsequent sale. So the client's requirement was advice on the movement from the source, from China, into the 4 locations. And as we heard earlier, invariably there's likely to be import tariffs, VAT and duty payable in all cases. And we were very well placed to advise on all these through our network, Lineal Global, which Frank mentioned earlier, with specialists in all the major territories. As Lucy mentioned, Inco Terms and understanding exactly who's responsible for these local taxes and tariffs is absolutely key, absolutely critical to maximising profit and avoiding hidden liabilities. So in relation to the goods coming into Europe, which is point 2 on the slide there, as far as the Dutch warehouse is concerned, if the goods are cleared, there will be Dutch import VAT and duty to pay, as you'd expect, at the warehouse. I say cleared because there are some regimes, again, Greg touched on those earlier, which would we would always consider, and they might allow us, the client, to defer or reduce these costs, the duty costs. But on this point, it's important, I think, to remember, because many clients get this confused really, that when levied import duty, unlike VAT, it can't be claimed back. There's no mechanism for reclaim. A big change post-transition will be that any movement from the Netherlands into the UK, point 3 here on the slide, will be an export, as Greg mentioned. Currently, as part of the customs union and therefore the single market, this movement, there's no duty to pay, and import VAT, or as we refer to it as acquisition VAT currently, is paid via entries on the UK VAT return. So there's no actual physical payment involved. But from January 2021, on the assumption, again, the assumption that the UK leaves the single market, and consequently duty will be payable potentially, again, depending on the exact nature of the goods, as Lucy touched on earlier, there will be duty payable even on the movement from the Netherlands to the UK. And import VAT will be payable as well, albeit under the new postponed accounting regime, which Greg touched on earlier. This would just be by way of entries again on the VAT return, albeit only for VAT registered businesses. If you're not VAT registered, this does mean that payment will be at point of entry. So overall, there's a real risk of the double whammy that was mentioned earlier, with duty payable twice within Europe, if we don't consider any planning opportunities. With the sales of physical stock, the merchandise, it's important to note that generally speaking, again, as Greg touched on earlier, sales to business customers are not VAT-able in the country of destination, VAT's accounted for, are VAT-able in the country of destination. VAT's accounted for by the business customer under rules referred to as tax shift or the reverse charge mechanism. You might hear that mentioned. The point being that where we've got sales to private individuals, they're generally taxed where the customer belongs. So, you know, we have the potential there for local VAT registrations. Those VAT registrations, and indeed with this particular client scenario, can be avoided using the one-stop shop that was mentioned by Greg earlier. And the same applies to services, because in terms of downloads of music, but equally to things like suppliers of software and so on, these digitally or electronically supplied services, where they're supplied B2C, would require local VAT registrations because they're taxed where the customer belongs. And in order to avoid those local registrations, the mini one-stop shop or MOS regime applies, soon to be extended to this OSS regime, the OSS regime, for more than just services. So that's fairly key to all of this. I think another thing just to mention would be the IP rights, which is point 4 on the slide there. UK into the Cayman Islands, that is a reverse charge item, which means self-charge by the recipient. And it's quite important to recognise that an expense coming from outside of the EU can still trigger a VAT charge, and in fact can even trigger a requirement to register for VAT, which would seem completely at odds really with the usual basis for registration around turnover and the generation of income. So it's a cost can trigger a requirement to register. So those are all things that we would cover for this client in a situation where they were talking about downloads, moving goods around the globe, but particularly within Europe. And I guess that there is no getting away from the fact that the UK leaving the EU is a bad thing.
All the information of the people on this call is on the slide deck in terms of emails and what have you. Again, you can do it through BPM. So again, I hope that this was informative. Again, I want to thank the panel members. I want to thank the BPM technical team because all these things are not feasible without a huge amount of infrastructure and experience. So again, thank you very much. And with that, we will close the webinar for this afternoon, for today. Thank you very much again.